Good afternoon and welcome to a special roundtable on behalf of the Global Ethical Finance Initiative, GEFI. And we're very grateful to our co-hosts today who are looking after this virtual platform, the CFA UK Scottish Committee. I'm Alan Watt, Senior Advisor to GEFI. And yesterday I was listening to the radio and there was an interview with Gennady Dusenko from the First Volunteer Mobile Hospital Team. He was a lawyer. He trained in Aberdeen. And he said he wasn't just fighting for Ukrainian independence, but he was fighting to defend civilization and fighting for humanity. These are very difficult situations and very difficult decisions need to be taken. And GEFI's been working with the global finance industry for over a decade to enable finance to be channeled towards the UN's Sustainable Development Goals. Even as late as the 8th of February, the Ukrainian UNDP published a review of how its fiscal and budgeting process could be measured and the progress and impact against the SDGs looked at. As we sat last year during GEFI's Global Steering Group in COP26 in Glasgow, Lord Alderdice, our moderator today, spoke last and made a very, very powerful point. There can be no sustainable planet without peace. Little did we know that only a few weeks later, we would all be faced with the most terrible dilemmas and choices over the stewardship of assets. So today's moderator, Lord Alderdice, I couldn't think of a better person to moderate this conversation. He lived through and was a major player and an actor in negotiating and establishing a settled peace in Northern Ireland. During today's event, if you wish to ask a question, there is a Q&A function. Please do use that. And at the end, David Clark from the CFA will sum up and say something as well about the Disasters Emergency Committee. So with that, I'd like to hand over to Lord Alderdice to lead today's discussion and introduce our speakers. Thank you, Lord Alderdice.
Alan, thank you very much indeed. As Alan says, my name is John Alderdice. I'm a member of the House of Lords, and I've been working for a long time on the challenges of violent political conflict in various parts of the world. In fact, that's really what brought me initially to GEFI. I became convinced that we needed a better way of engaging economically and socially as well as politically, and an ethical approach to finance is a very important part of that. Well, it's not easy to get a handle on the moving picture of current developments. It's obvious to everyone that the war in Ukraine is not only a humanitarian catastrophe, it also brings a wrecking ball to the global economy. And not only that, but of course, it hugely undermines our ability to tackle any of the pressing climate change challenges that our world faces. We're going to try to get a sense of these things this afternoon, and none of us should just opt out of the challenge. As Alan pointed out, we've been seeing in Ukraine, every single citizen, no matter what their personal circumstances or their professional background, everyone has a role and a responsibility in facing existential challenges like this. And I think that includes all of us. It includes those of us who are involved in the finance industry, finance professionals. All of us should be considering our personal role in securing peace and stability for the millions of people with whom we share this planet, shared but divided planet. So I'm delighted to participate in this event along with colleagues in GEFI and CFA UK, CFA Scotland. And our discussion today is going to focus on a number of issues: the ethical case for action, the forms of action that are available to those who are involved in finance, challenges of acting at the pace and scale required. As Alan pointed out, all of this has happened really extraordinarily quickly. We usually know better in advance. And then the role of finance in the longer term process of conflict resolution after the active hostilities have ended. And we obviously hope that that will be sooner rather than later. Well, we've got three marvellous guests who are going to help us to explore the situation. Jeremy Lawson, who's Chief Economist at ABRDN, Helen Thomas, who is CEO of Blonde Money, and Graham Cook, the CIO of the Environment Agency Pension Fund. And I'm going to start with an initial round of questions to each of the three guests. I'll say a few words of introduction and put a question to each in turn as a kind of starter. And then we'll come back to each of them with follow-up questions that I hope will help us to explore these four key issues. So, Jeremy, let's come to you first. Good to see you. Jeremy is the chief economist at ABRDN and head of the ABRDN Research Institute. Jeremy, you lead a multinational and global team of economists and researchers undertaking fundamental empirical research at the intersection of economics and politics, policy and markets. So, looking at the global picture, could the events we're living through see the return of what we came to call stagflation for the first time really since the 1970s? And to some extent, maybe for the same reason, a war involving major oil producers and their allies. What impacts is going to have on energy policy, but also on ordinary consumers? And we're all ordinary consumers in these areas. Jeremy.
Thank you. So maybe the first thing to begin with is just to emphasize how hard it is to forecast in the current circumstances. So let me provide an example. In the space of a couple of weeks, we've seen 20% moves up and down just in oil prices, natural gas prices in Europe by larger proportions than that. And then also ramifications through agricultural prices, supply chain prices. And so if you're trying to make an estimate for the future, you have to establish a starting point for that. But when the goalposts are moving by such large amounts on such a short-term basis, it is very difficult to do so. So you do have to try and focus on what I'd say is two things. One is, I think in these circumstances, point estimates are less useful than thinking about ranges and scenarios. So, for example, something that we do is we say, well, look, we have to establish a base case, like a central view, so that we can sort of do some planning and think through the potential consequences. But we then map out the different ways that might, that events might unfold, how they are different from that central scenario, and in particular in terms of the macroeconomic geopolitical consequences. So, for example, in the current circumstances, you have to be thinking about scenarios both in which there is a further substantial increase in commodity prices, the size of that commodity shock, but then also circumstances in which there is a de-escalation in those sort of prices, those prices drop. So that's one really important point. The second, I think, and maybe arguably more important, is as people have become very focused on this crisis, and then this sense in which, well, does the commodity shock, is that going to have consequences, or what are the consequences for global economic growth? Might we be heading into a near-term recession because of these changes? In some ways, this is causing people to lose focus on what might be the more important question, which was this shock is already occurring in an environment where a number of central banks had allowed themselves to get a long way behind the policy curve over the previous 12 months. So the Federal Reserve is a great example of that. If you look over the last 60 years, you'll find no example where the combination of a negative real policy rate of more than minus 5%, an unemployment rate below 4%, the nominal policy rate at 0, and where inflation, underlying inflation, core inflation as you'd often refer to it, is around 3 times above the central bank target. So to put it mildly, the central bank, the Fed, has a really significant problem on its hands, because in every other circumstance in which the central bank has been far behind the curve in the past, it hasn't been able to engineer a soft landing. You have sort of seen recessions. And actually, whether the Ukraine conflict ends up being resolved in a way that means that there is a drop back in commodity prices in the near term or a further increase, that same fundamental dilemma exists for investors and markets, because that's not going away, because it wasn't just a function of the Ukraine-Russia conflict in the first place. So that's just a point there. Now, stagflation, we have to be careful with that term. An environment in which you have a negative supply shock, like what the war is creating to commodity markets, that is stagflationary in the sense is that it tends to weaken growth and push up inflation simultaneously. But true stagflation, I think, really describes a state of the world that's more persistent than that. It's not about short-term moves. It's about sort of the duration of how long these last for. And it's very difficult to get into a true stagflationary environment unless central banks acquiesce to it. So take that what I was talking about with the Fed beforehand. If the Fed were to react to this shock, or what's already sort of happening in inflation dynamics, and say, you know what, we're so frightened of the unemployment consequences of tightening policy, we're just not going to do very much about it. We're going to withdraw policy very slowly. It's those types of circumstances where you're more likely to lock in high inflation through wage limits. Whereas if the Fed is committed to getting ahead of the curve, to effectively correcting the problem that it sort of created over the previous 12 to 18 months, then you're not going to be in a stagflationary environment, right? But you could be in a very weak economic growth environment, or even potentially a recession. So maybe another way of phrasing this is to say there's some really difficult adjustments coming almost either way, unless you're a very strong believer that almost all of the pickup in inflation over the previous 12, 18 months was due to transitory factors.
Thanks very much indeed. Well, you've already given us quite a lot to think about there, Jeremy. But let's come, Helen, to yourself. Helen Thomas, CEO of Blunt Money, as we can see behind you on the panel. Blunt Money is a risk consultancy, and you bring a lot to the table. You've had 20 years and more of experience in banking, fund management, and politics. During 2008, not a time that most of us remember terribly fondly, certainly from a financial point of view. You were advisor to George Osborne, the former Chancellor of the Exchequer, and later you helped Matt Hancock write his book on the financial crisis, Masters of Nothing. Helen, as you approach the questions of finance, how would you describe the response of government, and how are firms doing as they try to deal with the pace of these changes? Are they keeping up? Are they scrambling to manage, or do they just not know what to do at all?
Well, I think what we need to start with is differentiating. Effectively, there's actually two wars going on. There is a land war, of course, in Ukraine, but there's also an economic war. And I know, Lord Alderdice, you have reflected upon this in some of your speeches. The economic war, for me, this really ratcheted up. It wasn't just about the sanctions. I think the key shift politically came with the freezing of Russia's foreign exchange reserves. Completely unprecedented to a G20 nation, let alone one that is one of the top 10 FX reserve holders. And effectively what you've had is, because of that element, you're sort of engineering a currency crisis from both sides. So currency crises usually start with capital flight. Then the country tries to raise interest rates to stop it. Then they burn through their FX reserves. Then they get to capital controls. Effectively, the Western nations have imposed all of that upon Russia. And what is so important and significant about that is that effectively it takes a G20 country out of the financial system. So and we may well have a debate on the rights and the wrongs, but that is the facts on the ground. So there's an economic war happening. The market itself is being weaponized, again, for good or bad. But I think it's something we're going to obviously talk about today, is it is deliberately creating incentives, political incentives, to economic actors to try and achieve policy goals. And I have to tell you that, I've got some contacts in Westminster, and, Lord Alderdice, I'd be interested to hear your take on this as well. But, from the people that I know, from the start of this conflict and from those announcements about the currency reserves and SWIFT, of course, as well, a very, very consistent but aggressive tone. I have members of parliament messaging me to ask me where the ruble exchange rate is. I have them asking, how much are investors repudiating anyone or any business who has anything to do with Russia? Have we been able to bring that economy to its knees? And that is, to me, it was somewhat taken aback by the strength and vehemence of that. But I think what it shows you is the resolve politically towards the economic war. And a step further to that, which we may get into, following on from Jeremy's very good setting out of the economic scene there, What about a response from the fiscal side? We've heard there about obviously the Federal Reserve on the monetary side. What about the fiscal side? Because here in the UK, there is certainly an element of the government who are very concerned that there's already been a lot of money that has been spent. And yes, we obviously have a lot of inflation, and this is going to create a lot more. But what can you do and what should you do on the fiscal side to alleviate, what is now becoming this really protracted cost of living crisis? So what I've been advising to my clients, and, I started my business precisely because political risk is extremely difficult for financial actors to quantify and to get into their investment process. But very simply put, whatever it takes, that famous phrase came, started with Mr. Draghi and was incorporated in the depths of the pandemic. Whatever it takes has become almost whatever it takes to bear down on inflation, which is a different angle. And of course, why Boris Johnson is visiting Saudi Arabia is part of that plan. So I think my overall sense of this, and what I'd like to get across to the people listening today, is the economic war is happening. It will continue to happen, whatever the fate of the land war. And although we're all scrambling, all of market participants were all scrambling to assess what it means, we must, because we are actors in this process. I think you were saying there at the beginning, we all have a part to play. Effectively, we are a front in this war now, those of us involved in financial markets.
Thank you very much indeed, Helen. And the more you speak, the more the seriousness of the thing develops. And I don't think Graham is going to give us a great deal of easement. Graham, we're going to come to you now. Graham Cook, Chief Investment Officer of the Environment Agency Pension Fund. You bring more than 25 years of industry experience to the table here in the UK, Europe, Australia, primarily helping asset owners efficiently implement their investment strategy. You're currently CIO of the Environment Agency Pension Fund, and you have to oversee the investment management arrangements of somewhere around £5 billion, and at the same time try to ensure that the agency's pension fund addresses the challenges of climate change. Of all the government agencies, you certainly can't afford to be the one that's ignoring that particular crisis. So, Graham, do investors, whether they're private investors or government agencies, do they have some kind of moral responsibility to go further than what's been required and implemented so far by governments? Do you think, for example, that the Environment Agency Pension Fund should be giving a lead to other government agencies because of the area that your agency is responsible for, the agency for which you're providing the pension fund? Well, what do you think? And what can you actually do? Because, of course, you may think that there are things that you'd like to do, but you may not be able to do them. So a number of challenges there. We'd like to hear your thoughts on.
Yeah, look, I think the ethical side is a really difficult one as an institutional investor. We're obviously a pension fund. We're a public sector pension fund, part of the local government pension scheme. And whilst we consider ourselves a leader in responsible investment, that's very different from being an ethical investor. And there are a lot of constraints that, as a pension fund, the fiduciary responsibilities that you have to the beneficiaries, your members, but also the requirement to be prudent as well. Yeah, they do constrain your ability to be ethical. There is a very small amount of leeway that you can have in taking ethical decisions, certainly for our scheme as part of the LDPS, where you know that your members agree with you overwhelmingly and there is no material financial detriment to the pension fund. But otherwise, we have to take all of this as an investment issue. And it's very much how we've approached the issue. Yeah, we have, fortunately, very minimal exposure to Russia and Ukraine directly. That's partly because we don't have any emerging market mandates, but also because of our responsible investment policy, which takes into account environmental, social, and governance issues. Our managers, which follow that, have found very few investment opportunities within Russia that meet those criteria. It's not really been a happy hunting ground. If you're looking for good governance or you want good social outcomes or positive environmental outcomes, Russia just really hasn't been there. So I think our responsible investment policy, whilst it's not ethical, has actually protected us from some of these issues and helped drive how we approach this at the moment. In terms of what you want to do, the constraints really are practical. So as much as you might want to divest from Russia, if you were to have significant holdings, that's not very easy to do when the stock exchange is closed. And even if the bond market, which is an over-the-counter market, is open, you can't actually settle any trades because you can't deal with any of the banks or touch rubles, etc. I know people will say that you can look at the ADR market and trade liquidly in there. We've been seeing volatility of 70 or 80% in a day in ADRs as they bounce up and down by that amount, trying to adjust to what the latest situation is. From our point of view, on a prudence basis and a fiduciary basis, I think the case to invest in Russia is pretty clear that it's neither prudent nor in line with fiduciary responsibilities, given the uncertainty and the economic environment, sanctions environment around there, to actually make any new investments in Russia. And so we will be divesting as practically able to do so, the very minimal exposure that we have. But we are working with our managers to ensure that there are no new investments in there, because that, as our fiduciary responsibility and acting prudently, new investments into Russia is definitely not one that we feel that we're able to do.
Thanks very much indeed, Graham. Well, there are a series of things that I hope we can open up and tease out a little bit over the next little while, the next half an hour or so. And I would encourage, if any of the three of you, whenever one of your colleagues is speaking, feel that you'd like to come in, let's try to find a way of doing that and having a conversation rather than just sticking with something that's restrictively orderly, if I put it in that way. Jeremy, when you've been talking with your colleagues in Aberdeen and thinking about the challenges, of course, we don't know. We were talking about this before we came on air. We don't really know what the future will hold. We have to sort of guess and speculate a bit. But in general terms, do you think that we're going to find ourselves moving backwards, regressing into something from the past in the way that we engage economically and financially? Or is this going to trigger some kind of forward development in various areas? I mean, for example, some people say, well, because of the energy problems, that's actually going to force us to find new ways of taking forward sustainable energy supplies. Do you have any thoughts about that? I guess it may be that it's a mixed picture, but I'm sure it's one that you and Aberdeen colleagues have had to think about.
Yeah, of course. We absolutely have to think about these things. I said to you earlier, one thing we have to be a little bit careful about is an event that very few people predicted to happen as late as a month before Russia invaded Ukraine, is that now have too much confidence about the long-term future consequences of that conflict. So a degree of humility is necessary in these circumstances. But I think a few things that might help. So one is, and I think this relates actually to one of Helen's points, right? Because she sort of framed this in terms of an economic war running parallel to the land war. And in a sense, we need to go even further back than this, because from an economic perspective, the global system has been fragmenting for quite some time. It's a little bit, people on this call might remember, it wasn't that far ago, is the trade war, the so-called trade war between the United States and China. And even though the headlines of that aren't as extreme now, Joe Biden's administration haven't dismantled none of the tariffs that were erected sort of during that particular conflict. Even before Trump was elected, we have an index of globalization that shows very clearly that globalization was slowing well before Trump was elected, in part because the political dynamics, social, political, economic dynamics within the advanced economies was shifting. The incentive structure was changing quite a lot. So to my mind, this conflict, in a sense, it's symbolic of and reinforces a tendency towards fragmentation that has been in place for more than a decade. Now, that doesn't mean, though, it's all linear. It's possible that, for example, this might ultimately strengthen the NATO alliance, as an example, which had sort of been fracturing along some elements beforehand. There are some really fascinating questions about how China is going to respond and behave in a set of circumstances in which earlier in February they signed a pact to, an energy and security and economic pact with Russia, but at the same time, China arguably has an enormous amount of stake in that fracturing of the international global economic and order not happening quickly, given its critical role within it. There are some really fascinating questions about what this means for climate change and climate policy, where again, I think the watchword is nuanced. So, for example, in the EU ETS, I've seen some people sort of say, well, this might mean that we need more, this might slow the energy transition because there will need to be a greater short-term reliance on coal. But the nature of an emissions trading scheme is that you set an emissions budget over a period of time that determines how much covered emissions are declining. And then it's the carbon price, the permit price that is fluctuating in order to achieve that particular outcome. Obviously, in other countries which don't have formal carbon pricing mechanisms, then there will be very difficult political choices. Some will look at this and say, you know what, we're too dependent on importing hydrocarbons from unstable regimes. We need to sort of double down and increase our investment in renewable technologies. But equally, others might look at that and say, you know what, we need more hydrocarbon independence. And so the focus of investment might not be on clean energy solutions at all. And those choices will differ quite a lot across countries. So something that we try and do is take account of that nuance in the way that we build frameworks for analyzing how ESG climate factors influence investment decision making. So we do that through climate scenarios. We have a macro ESG index, or a way to try and take into account how governance, social factors, environmental factors differ across countries. So that can be used as a complement in day-to-day decision making. Because let's think about ESG investing just for a moment. ESG investing was founded on the principle that it was going to be a lens to assess risk within a micro bottom-up investing processes primarily, right? But what this highlights is that in any process, you need to take into account these big macro drivers, because if you've got no framework to do that, right, then how can you assess that risk properly? But equally, you don't want to be doing that on the fly, right? Because, for example, Russia is not the first and it won't be the last country to invade a neighbor or another sovereign nation. War is awful, but it's not the only dimension of unethical sovereign behavior. So how can we approach this more systematically? What can we do to be able to look ahead so that we're not reacting to these changes, but assessing the risk beforehand so that, again, we can sort of plan more appropriately in our decision making?
Sure, Graham.
I just want to come in on that, and it won't surprise anyone to know this is one of our major concerns at the Environment Agency, and also with my IIGCC hat on, is that, you know, the move and the momentum that we got from COP26, you know, to actually move to net zero by 2050 and get everybody on that path is at risk of being derailed from this. And I think it's really important that governments around the world put in policies in place, and there is policy support to accelerate that move to renewables. Germany, I think, have committed to 2035 to have all of their energy from renewable sources. We'd love to see the rest of the world get down that route as well. You know, there are other things that are important as well. Energy efficiency, etc., can help move this, but there is a real risk that, you know, we do move more onto coal, other sources of oil and gas, digging up the North Sea, again and reopening, the worlds there. These are things that, can really derail that. And we need to be conscious of those effects. And it's something that we are particularly concerned about.
Thanks very much, Graham. One of the things that's emerging from this, and you actually pointed up to it, Jeremy, is that even before this particular crisis, there were other things already happening. It's almost difficult to remember. A few weeks ago, there was nothing on the news except COVID, and now it's pretty much disappeared off the news, despite the fact that in a number of areas the figures are even higher than they were at that time. And before that it was Brexit, and before that it's climate, and so on. There isn't one set of issues here that's determining everything. There's a whole mixture of things working together, but there does seem to be this fragmentation taking place. Helen, do you think that we're now going to see a fragmentation of the global finance system, with Russia being squeezed out, out of SWIFT and out of a whole bunch of things? Most favoured status is gone and whatnot, but linking up more closely to China. I mean, are we going to move back to some kind of bipolar Cold War type world? Any thoughts about that from a financial system point of view?
Well, of course, I've been just over 20 years in the markets. I'm pretty sure when I started, everyone thought that the dollar was going to collapse and no longer be a reserve currency. So, there's that famous expression about, its death has been much exaggerated. So I don't think we should be in a rush to rule out the dollar. But I do think has been clear as well over the last 2 to 3 decades about the rise of China, its importance to the financial system, and of course, yes, the risk of a bipolar world. And I think that is fair, from a geopolitical standpoint, that nations and history evolves. If we take a sort of centuries long view of this, the US is maturing and China and other emerging nations have emerged. So I think we should be very much aware of the risk of a secondary financial system. I say a risk. It's just an evolution, really. But investors have to, I guess, decide which system they may want to be in. I mean, Russia has been developing an alternative to SWIFT for many, many years. China, of course, has been trying to get the renminbi more influential, certainly in Africa, with swap lines to other nations, other emerging nations. So, but I do think that this point does mark very much a shift. I think we should not underestimate that we are in a new world order. And one point I'd like to pick up on Jeremy's there about the fragmentation. So the way I've been looking at this was 2008-9, we had a rise of the anti-establishment sentiment, which expressed itself in a number of different ways, some of which you've discussed, like Brexit and Trump. The irony, of course, of something like Trump would be, a real estate developer from New York apparently is outside the establishment. But anyway, such is the way that politicians can sometimes sell themselves. So I think we had that, and it made sense because, of course, the financial crisis left people feeling that the system didn't work for them. The establishment didn't work. But the pandemic, I believe, has introduced a new cleavage through politics because, of course, it's all very well to reject the establishment, but in a true national emergency, the only actor that can respond is the state. And of course, the state has become bigger in everybody's lives, in everybody's nation, whether it is, in terms of the help it can give with COVID testing, but also, of course, restrictions on our freedoms. So what I'm looking at now is a split. It's no longer the establishment versus anti-establishment. It's almost authoritarian versus libertarian. And that cleavage is kind of, it's sending the electorate off in lots of different directions, which actually becomes extremely difficult politically if you want to build a coalition, because although for a long time we have talked about you need to build coalitions from the center, the sad truth when you have a financial crisis, a health crisis, of course you have extreme responses. People get spat out into the extremes. And if you just very broadly consider there being sort of, instead of just an economic left-right, you have almost this authoritarian versus libertarian angle. You get these four groups, and it's very, very difficult to put them together. And actually, a lot of Boris Johnson's woes come from the fact despite that massive majority that he won, which appeared to be on one sort of single issue, it was a coalition of different groups of people who all now want quite a different response. And hence the troubles he's in. And by the way, the troubles we think he will continue to be in, despite the headlines having taken him off the front pages. So that was probably a very long answer for in taking on Jeremy's point about fragmentation and accepting electorates are more splintered and potentially more extreme. So policy making is very difficult.
I'd agree with a lot of what Helen just said. Another way of framing it would be the return of the state as an influential force in economic and financial development. So I think that is a clear implication. And I think what we're going to learn is that it can be both a force for good and a force for challenge, right? So on the good, so you take Graham's point, we can't address climate change fundamentally without regulation, right? So climate change is a market failure. You have to solve market failure through climate policy, climate regulation. At the moment, despite COP26, the world is absolutely not on a net zero 2050 pathway, not even close to it. Global emissions need to decline by 7% per annum over the next 30 years. In order to achieve those objectives. And actually 2022 is going to be a new historic high for global emissions, most likely. So there's a need to do a lot. But equally, we're going to learn things about public choice. So, for example, as the state intervenes, is it going to get things right all the time? Arguably, the Biden administration and the fiscal policy stimulus that was put in place last year in particular was an excess, right, that was delivered, an overreaction to the COVID crisis that is part of the reason why the Fed is facing the dilemma that it is today. Helen mentioned that we might get some, in the next budget, we may get some support for households to alleviate some of the cost of living crisis in the UK, but that actually represents a form of fiscal stimulus, right? So actually, it could ultimately make the inflation problem worse in some ways, even as it's sort of trying or it's being sold as a solution to the problem. So I think that we're going to have to almost put our 1960s and 1970s hats back on, not just from the sense of where inflation sits, but just the lens, which is instead of a world in which governments were looking for ways to get out of the way, right? How can we, in a Washington consensus, deregulate the labor market, deregulate the product market, trade liberalization? In a sense, it's what is government doing? How is it changing things? But be able to recognize what's it doing well, what's it doing badly? Because again, we're investors. We're here because this is about finance, and the answers to these questions will have fundamental implications for the nature of returns, not just at an aggregate level, but the composition of those returns.
Graham, I want to come to you and pick up on some of those things that Jeremy's just said, because the dilemma that he's pointing out is, well, first of all, and one of our colleagues who's listening in, Mike Clark, has pointed out that prediction is very difficult, and economics doesn't have a terribly good record in terms of predicting. As Oscar Wilde said, prediction is very difficult, especially when it's about the future. But one of the difficulties is we're approaching it from different perspectives. First of all, there are those who are approaching it from the perspective of our responsibility is to manage these funds and, make the best kind of outcome to the funds as possible. And of course, there isn't even agreement on what is the best way, because there are some who take one perspective on what's the best way to get an outcome and others who take another. But then there's another way of thinking about things, which particularly comes to bear, as Helen has pointed out, in situations of war and threat. And that is where people say, it doesn't matter what it costs, this is the right thing to do. We must do this, either because it's a political requirement or an environmental requirement or whatever. How do you find yourself dealing with these? Because in the environmental context, you have a set of responsibilities which are the normal fiduciary responsibilities. And then you've this set where people say, well, whatever it costs, we've got to do this because it's the right thing to do. That must be a bit of a dilemma for you.
It is a little. I'd admit it can, prove difficulties. But, for us, we're a long-term investor. We're a pension fund that's going to be paying pensions until the end of this century. We have to take a long-term view. So the duration of our liabilities is over 20 years. That means at least half of the payments we need to make will occur in more than 20 years' time. So we have to take that long-term view about what's appropriate for us in our investment strategy to get those long-term views. And investing in sustainability is a core one of that. But we still have to get the returns that we need to earn in order to be able to pay the pensions that we have. So there is a bit of tension there, but it's generally relieved by taking a very long-term view about what we're trying to do, which is actually generate cash flows for pretty much the rest of this century. And you'll only do that if there's a functioning economy in place to do that. And therefore, it's less for us as investors to sort of challenge the policy, but actually take on board what it is and figure out where we need to be going in order to get to where we need to go. If that makes sense.
It certainly does. It certainly does. It doesn't make it easy, but it certainly makes sense. Helen, I want to come to you because we've been reflecting on how some old problems tend to come back. Wars are not going to stop. I think as Jeremy said earlier on, this is just part of the human condition. It's going to keep coming back. And we've been reflecting on how some problems and challenges return. But there are also some new developments, some technologically new developments. And one of them, of course, is the appearance of cryptocurrency. And people have been talking about this quite a lot. For example, money or resources being channeled to Ukraine using cryptocurrency, for example. But it's been around in all sorts of ways. I think this is something that you've been looking at, and I'd like to hear what your thoughts are about it.
Well, from a very top-level perspective, cryptocurrency is a decentralized ledger facing a centralized government, or each nation state, and there's a natural tension there, which the technology is not going to go away, so that tension isn't going to go away. And we have seen more and more regulations coming from governments regarding crypto assets. Indeed, even the sanctions information that we've had. I mean, it was a G7 joint statement. I think it was Friday last week, and it had 7 steps, 7 commitments, and one of them specifically referred to digital assets and how they must also be part of the sanctions process. So this is one of the first tests of that new technology. Now, like most new technology, there is challenge and opportunity. So as you've outlined there, it has been a way for Ukraine to get funds. I've seen, Ukraine government tweeting about its, the keys of its digital wallets. And I think it's raised, it was $54 million in the last count that I saw from various cryptocurrencies. But of course, there is the threat that it may be used for sanctions evasion. However, again, opportunity, and this is something I've been digging into because I have to hold my hands up and say, I am new to this. I am learning. I need to know more about this technology, and I've been digging into it. And I had labored under the misperception that, blockchain transactions were anonymous, but they're actually pseudonymous. So technically, because obviously there's a transparent ledger, you can go through and find out who or what might be behind that. And, some of the statistics out there, suggest that, the illicit transactions within the cryptocurrency world are less than 1%, whereas the US dollar can be between 2 and 5%. We shouldn't forget that, borders are back, but somebody can still try and get a briefcase full of dollar cash and take it physically across a border if they want to try and evade sanctions. So, but I think it is, I think we should be on the watch for looking, I think we all as investors need to bring this technology in from the cold. I know it's extremely difficult, when you're an asset allocator, goodness knows you've got enough on your plate if you're looking at stocks, bonds, commodities, currencies, real assets, etc., and now digital assets, and they're all very different as well. But what has become very clear to me is that the technology is not going away. We must embrace it, and it does actually provide opportunity. But I'll get back to my original point on it. how do we resolve that tension? It's a naturally decentralized system in a world where, as Jeremy was saying, we have, the nation state is back, borders are back. And I think we will have a conflict about that system. That tension will grow until it's resolved.
Jeremy, have you and your colleagues at Aberdeen been able to develop models or modelling that enables you to take into account the complexity of what we've been talking about? Because we've been talking about the fact that there's all sorts of things going on at the same time. It's not, and I think you used the word linear and said it's not linear. And of course, that's obviously right. Are you able to develop models that enable you to take into account the complexity of what's going on?
Yeah, I mean, let me provide an example of where we try and do that. Now, we'd be very careful. No model is ever going to be a fully accurate representation of the world that it aims to describe. It's complementary to decision making. It's not a substitute for judgment, but it should help inform good judgment. But I'm going to we'll go back to the climate change example, which I'm sure a lot of people listening to this will find useful. As people probably know, there's this huge industry that's developed around climate scenario analysis over the past few years. A lot of this is being driven by regulation, so the requirement that asset owners in particular are able to understand the nature of the climate risks and opportunities that they're exposed to. A lot of the demand comes from our clients. So you raised the question earlier, which was, well, is there a choice between this is the right thing to do, or is this because it's actually a fundamental driver of my investment return? The truth is that some different asset owners, they have different lenses on that question. It's not actually our job to say that's the right or wrong, but we need to be able to respond depending on what their need is. And then equally, it's absolutely fundamentally clear that there is a significant energy transition taking place, right, across the world, that even if you don't have to believe that we're on a net zero pathway to know that the composition of energy usage is changing radically, on near and long-term horizons. But that all of this is going to be heavily influenced by different technology pathways, different policy pathways. Those policies are going to be determined by political choices ultimately, and the choices made in the United States are not going to be the same as the choices made in China, and are not going to be the same as the choices made in continental Europe. But if you, when you're doing that analysis, have a model that says, I'm going to assume that every country has the same climate goal. Now, what happens to asset prices if I make that assumption? You're going to get a completely different answer when you're trying to understand which securities are going to do well in this environment, which are going to do badly in that environment. How do I understand the drivers? Then if you take that into account. So what we've done at Aberdeen is we've developed a bespoke framework where we design effectively our own climate scenarios in partnership with Planetrix, who are a climate modeling consultancy, where we can take that difference into account. And what we think then is we can generate very different insights about how different assets are exposed to the energy transition, to physical climate change, not again as a substitution for decision making, but as a way to get a lens on what those exposures, what those risks, what those opportunities are that you weren't taking political economy considerations into account. So it's a bit like what Helen said earlier, right? Political economy is fundamental to investment decision making, right? Because it sets so much of the background through which asset prices, investment decisions are being made. And if you're ignoring it, then you miss a really fundamental driver, particularly as you stretch your horizon sort of beyond the very short term, but even over short-term considerations.
But here's the dilemma, Graham. The political economy, which Jeremy's just been describing, there are periods of time when it's relatively constant and changes, but the change takes place over a period of time and so on. And then there are situations where aspects of the politics changes incredibly dramatically very quickly. Now, you were speaking earlier on about how, in the nature of things, managing a pension fund, you're a long-term investor. You're not looking for the immediate thing. But as one of our listeners, Marietta, has pointed out, quite a lot of funds simply dumped Russian stocks in the last few weeks. There's been a dramatic change because the politics has changed. Then the whole business. How do you, as a long-term investor, manage when these really serious, not little ripples and bumps in the road, but really major dramatic changes like we're seeing at the moment. How do you address that kind of thing when you're a long-term investor, as you are?
Well, the key to that really is our investment strategy, and our responsible investment strategy is being very clear about what we're trying to achieve and how we're going to get there, and the criteria that we set out, particularly in our responsible investment strategy, in terms of the standards that we set in terms of environmental and social and governance. Those are constant, and to Jeremy's point, the end game doesn't change. We are going to get to the point. We are going to have the industrial revolution or energy revolution there that's going to get us to net zero. But the pathway of getting there may well change, and we have to be, adaptive to that. But at the end of the day, our investment strategy is, or our investment activity is driven by our strategy, which is a long-term strategy, and we can take into account deviations from a pathway. But at the end of the day, everything's dependent on us, the end game not changing and us getting there. And I think the key would be if there was a serious possibility that we don't get to net zero at 2050 and we're really knocked off course. We'll have to readdress where we are, but our investment philosophy, doesn't change, and having a really well thought out investment strategy and responsible investment policy helps us keep that constancy, and helps us with our decision making, and we don't have to make big decisions on the fly, as it were.
Thanks very much. That's extremely helpful. We're coming into our last 6 or 7 minutes now, and I'd like to come back to each of you for a response on something that's emerged specifically from what you've said. Helen, one of the things that was interesting to me about your comments was you kind of taking a philosophical perspective on things, and this question of economic war. You're quite right. I got a bit frustrated when people were talking about sanctions. Sanctions is where there's an authority that sets down rules, people break them, and they're sanctioned. Problem is, the authority itself has broken down now. The Security Council of the UN can't agree on things. So what we're finding is economic warfare taking place, not the imposition of a sanctions regime, because you can't when there's no authority that's agreed. Where do you think this takes us in terms of understanding these matters from an intellectual point of view? How do you think this helps us to explore the challenges we're facing in a world that's changing very quickly in terms of how we think about these things?
Well, I like your phrase economic warfare. I think that's even better. I think that's absolutely spot on. And so, we said earlier on, I think Jeremy said, there's always a war going to happen somewhere, but the methodology of war may shift and may change. And of course, it may well change based on the international world order. I would go back to my point about the breakdown of the establishment, of the challenge to the establishment. What we've seen with that was a challenge to supranational entities, of which the UN is one. But prior to that, we obviously had Trump's challenges to NATO, although that may well now, particularly given Germany's response, we may well actually see that supranational authority strengthen. Ukraine applying to join the EU, just obviously as Britain has left. There's, to be honest with you, quite from a historical perspective, we had quite a long time period of a settlement almost about these supranational institutions. We probably should have expected them to shift sooner rather than later, particularly with all the pressure that they've come under. So I think I look at it like this, which is we're in a transition phase to the new kind of globalization, the new kind of borders, the new kind of cooperation. We haven't got there yet. And I'm afraid it's probably going to be at least a decade, if not two, before we do get to that new settlement, which does mean from an investment perspective. I mean, I know Graham is there as a long-term investor, which, many people listening may well be. But of course, it's pretty difficult to navigate that transition phase. So I think the way that you want to be assessing this is, challenge your own assumptions about what is economically possible, because what is politically possible is now extremely different. And that is potentially good, but it could also throw up an awful lot of challenges. We might get a lot further on the path to net zero, but we might get some countries regressing into, an old fossil fuel state. We might get two bipolar financial systems, but one in the West may be a lot stronger than the one, let's say, of the East/Africa/Latin America. So be prepared to think the unthinkable. And I know after the 2 years you've all had, that might feel like, oh my God, do I have to? But I have to tell you that we need our history hats on, as I think Jeremy said, because things are going to be very politically volatile, so very economically volatile.
Well, down to the last couple of questions, one to Jeremy and one to Graham. Jeremy, we've focused quite a lot on Russia and Ukraine and so, because that's very much around in our minds. But one of the other things that's emerging in that story and beyond is the role of China. And of course, it's been around a lot for a long time, but it's emerging in a particular way currently and in the crisis. Any thoughts from you in the last few minutes on China?
In some ways, I think that's actually more fundamental to the narrative that we've been talking about. So let's use our two examples. There is no energy transition without a Chinese energy transition, right? China is the world's largest carbon emitter. It has a stated 2060 objective to decarbonize, but with, I think, some legitimate questions about the credibility of that decarbonisation pathway. But absolutely, there can be no global net zero without ultimately a China net zero. So it's fundamental in the fight, against climate change. That in some ways ought to be something that draws the world together, because climate change can't be solved individually. It's a collective action problem. At the same time, China is the counterpart to that fundamental story that Helen and I have been articulating around whether you describe it as fragmentation, a new order, a counterbalance to American hegemony. The point being is that it is that complacency that existed, I think, up until the last years of the Obama administration. This was the idea that China was on a long-term pathway to effectively converge eventually on Western political institutions and frameworks, and now a realization that it is an alternative model. It's not going away anytime soon, and in some ways is sort of strengthening, or at least is prepared to assert itself more. And so that, I think, is the more fundamental question: is can we find a way, a bridge that brings these things back together, right, in a way so that we're not faced with these invidious choices, America or China, but instead America and China, right? Technology, decentralization of finance, right? There are so many of these things which ultimately, if we break down and fragment, they become much harder to navigate. But to me, the current signs are not great, right? Because and not through the fault of any one particular side, right? There are changes going on both sides of that particular conflict. What's sort of very clear is that at the moment it's on a trajectory that's pulling apart, and that does have consequences for investors.
I have to interrupt there, Jeremy.
Sorry, yeah.
I have to interrupt there because we're in our last minute, and I do want Graham to have an opportunity to comment. I noticed you were nodding your head when Jeremy was talking about China there, Graham.
Yeah, look, I think China is the key here. And there's been lots of talk this week about whether China will actually side with Russia, provide its support, allow it to avoid sanctions, etc. We're talking about a whole different scale of problem that we have to address. Yeah, way beyond. Russia is pretty much insignificant in comparison to China, particularly when we look at the issues. There are going to be big issues in terms of supply chains, food production or agricultural markets, oil and gas prices, etc. We could have a shock bigger than the 1970s if China, were to become part of the other side, if you like, and part of that. We're onto a whole different ballgame.
Well, we would certainly need a longer session if we're going to bring in China. But I just want to say thank you to all three of you for what's been a really lively and stimulating session, and turn to David Clark. David, I turn to you to see us out.
Well, look, thank you very much to all of you. Thank you, Lord Alderdice. Thank you to the three of you. Just to say, really, I was very heartened by Graham's point that when he said that they hadn't been holding many Russian securities, because I think in some way the principle that we've discovered through ESG holds throughout, that good companies make good investments. And by investing in good companies, you're doing good. And of course, the opposite follows. You're unlikely to be a good company if you exist or do business in a corrupt or an authoritarian regime. So I think that's worth bearing in mind with this. It's one thing that I really wanted to point out at the end of this is that because it's a free event, we'd really appreciate if you appreciated it and enjoyed it. We're encouraging anyone who attended, if they feel able, to give money through the Red Cross, through the Disasters Emergency Committee campaign in the UK, or if you're outside the UK listening in, to do this through your local Red Cross Society. So really, it just falls on me then to say thank you very much from a CFA perspective. Ethics is at the heart of what we do, and we're always keen to get these conversations going because it's very important in the process for all of our members as a profession. So thank you very much. Thank you to GEFI for being involved, and hopefully we can continue the conversation in this area. Thank you.